The Reserve Bank of Australia has made an historic move, cutting the official cash rate for the first time since November 2020, providing much needed relief for so many homeowners out there. The reduction from 4.35% to 4.1% comes as inflation shows signs of easing and provides a vital boost to mortgage holders. However, the RBA remains cautious, highlighting uncertainties in the economic outlook and also potential risks to inflation continuing upwards. To get more, we're joined here in the studio by Professor Tim Harcourt from UTS, host of the Airport Economist channel right here on Ticker. Always good to see you. Relief for homeowners and relief too for the Prime Minister.
I think the Prime Minister would be celebrating at his Central Coast home had he moved there already. But I think the Treasurer, because I mean this has really been on him the whole time, and like it or not, Reserve Bank interest rate cuts do have political impacts.
Could it have come sooner?
Well, the RBA, Michelle Bullock, has been pretty clear that the RBA's job is to keep inflation within the 2 to 3% band, and she's a traditional central banker. I used to work at the Reserve Bank with Michelle, and she's a pretty textbook central banker, so I wasn't expecting it to be soon because they had inflation risk. A
really difficult time for anyone at the Reserve Bank. You mentioned the government, but also for the Reserve Bank trying to make the right decision at the right time. Do you think this is the right time for the 0.25%?
I think it was inevitable given the way the Federal Reserve's gone and the central banks elsewhere. And I think, the last inflation numbers showed some good signs. And so if not now, when? And look, people say, oh, it's political, but if you don't cut rates, it's also political. So in some ways, they've just got to do their job as central bankers and forget the politics.
Let's talk about the banks. They're now quickly passing it on. Obviously, they've made a lot of money the past couple of years from rates being higher. Talk to us about what the expectations are of the banks.
Well, the banks tend to move together, the big four. Some get a little bit ahead of the pack, but the rest follow. So I suspect you'll see it passed on. Some economists say there'll be two more cuts. David Bassanese at BA Shares has been one of the prominent ones out of the pack saying that. So we've got one. We could expect two more this year.
Why do you think that is? Is it because the economy is too tight? Is it because too many people are struggling? What's your view on it?
Well, both of those reasons, and also we had very high inflation. A lot of it could not be blamed on overseas impacts. It was services inflation domestically, and the RBA was pretty clear about that. That's now dissipated a bit, so they felt they had a bit more room. However, as you and I have spoken on Ticker, with the threat of the Trump tariff rises, that of course could have inflationary impact down the track. So whilst the RBA was confident enough to cut rates now, if there's some impact of a trade war, of increased tariffs, that could change the outlook down the track.
The challenge is that we're not out of the woods yet, and for a lot of businesses, 25 basis points, it's a start, but hardly going to see a flood of customers come in. We've heard about the amount of insolvencies around Australia for businesses over the past year. It's only been getting worse. Do you think that this will be enough to try and stem that tide?
I think it will help, but I think most market economists expect there'll be one more cut and maybe two. It will certainly be a relief, I think, politically for the government, who are coming under a lot of pressure. And you saw the backbenchers all commenting on the need for the RBA to cut rates and attacking the RBA, which is really not quite the right thing to do for politicians.
What about the labour market? Because some point to the labour market and say it's so tight out there that therefore that's a sign that inflation still has a way to go and that it's a good thing. Then you have others saying, well, the labour market's tight because the government keeps hiring workers in the government and the bureaucracy has been getting out of control. Where do you sit on this? And given that the bureaucracy has grown under Labor, I think 2 or 3 times compared to what we saw under the Gillard-Rudd governments, is it a sign that governments can increase the public sector and still rates will come down?
Yeah, look, I think there's not quite the same sort of inflation unemployment nexus we used to think there was, in the early 70s. And to some degree, I think it's sort of the quality of the labour force that you employ in government, not the size that matters so much. If it's in the wrong places, for instance, because there are labour shortages in some parts of the labour market. And also we have this issue with immigration. To what extent does that increase the supply of labour in the labour market, to what extent does that increase the demand for housing at hospitals and schools? And that's where we've seen, you know, I think governments right around the Western world, but particularly in Australia, really struggle with the impact of immigration on housing and the labour market.
We go back to 2019 where many economists were warning about the need for quantitative easing because it was looking so tough there. Then the massive yo-yo impact of COVID, which then we saw rates drop and panic emerge. Then afterwards rates have to go up, which caught the RBA off guard, where the former governor, Philip Lowe, said don't intend to increase rates, and then all of a sudden there's more than 10 in the space of 18 months. Do you think the yo-yoing has stopped? Do you think that, because that was always the risk, you drop rates and the economy soars and inflation therefore goes up again. Do you think that we have managed to avoid that?
Well, so far, I think we had a lot of government spending that was COVID related flushed through the system, and it took a long time for that to, you know, to have its inflationary impacts dissipate.
It's interesting, they blame the Ukraine war for inflation, not government spending during COVID.
No, well, the Ukraine war had some effect in agricultural prices, but you've got to say the COVID spending had a lot bigger impact than we thought.
Or billions of dollars, right, going through the system.
And the labour market implications. And then, of course, immigration was stopped, foreign students were stopped, and then they were all let back in a year. That's got to have economic impact.
Where do you think we're at? Do you think it stopped, the yo-yo, or do you think we'll carry on going up and down in terms of inflation and jobs numbers?
I think we've always got to manage the labour market and inflation astutely, not with rigid laws, but I think with some judgment, and I think that's the best central bank governors can.
Tim Harcourt, appreciate your time.
Thank you, Aaron.